All right, it's finally Fed Day. It's finally here, the last Fed Day of 2024. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, the final countdown. Powell and his colleagues set to deliver another quarter-point rate cut today at the last meeting of 2024. And with that decision upon us, we'll discuss the implications for markets, real estate, and more with Lazard's Ron Temple, Marathon's Bruce Richards, and with Bess Freedman of Brown Harris Stevens. Plus, MicroStrategy's momentum. We'll speak to the man at the center of one of the most important investment stories of the year, Michael Saylor, chairman and the biggest corporate buyer of Bitcoin. All of that and more coming up. Let's take a look at where markets are trading right now on this Fed Day. You can see we have a little bit of green on the S&P 500, but actually the momentum has been failing in the pre-market. You can see that the big tech index, your NASDAQ 100, flipped into negative territory. We had been looking at gains a little bit earlier. We do have Micron coming up after the bell, but all of the focus today is on the Fed, especially for the bond market, kind of at a standstill right now as we await that 2 p.m. decision. You can see the 10-year yield pretty much flat on the day right now, Sonali, but the level quite elevated, camped out at about 440.
A perfect 4.4%, Katie. It's interesting to see those moves over the past week. Also moving, we're going to take a look at some stocks. We're watching General Mills. Adjusted earnings per share beat estimates, but targets organic sales for the full year at the lower end of the previously given ranges. General Mills now down 4.4% pre-market. Birkenstock also reported earnings. Sales rose 22% in the most recent quarter as its closed-toe sandals, also known as clogs, are having a moment. Birkenstock's up almost 8% pre-market. I wear the open-toed type for what it's worth. NVIDIA also up 2.6%, finally getting some relief, a rebound. The stock had closed at the lowest level since October and entered correction territory this week. We're seeing a bid back into it, Katie.
I'm glad you said clogs because I don't know what a closed-toe sandal is. To me, that's just a shoe. But in any case, you think about where we are in this market on this final Fed Day of 2024, it really feels like we're limping to the finish here because the S&P 500, it's still elevated, but it's been really interesting, Sonali, to watch breadth just deteriorate here. We have some great stats in our morning email from our producer, Dan Curtis, saying that only 18.7% of S&P 500 members are up this month. That has put the index on track for the lightest monthly advance by breadth on record.
Incredible. He also had told us that more stocks in the S&P 500 have fallen than risen each of the last 12 days. That is actually, fun fact, the longest streak on record.
There you go. So plenty of superlatives to sort through here. And of course, we'll see if the Fed can give us some direction, because for right now, we are trading sideways. Let's talk about it all now with Lazard Chief Market Strategist Ron Temple joining us on set. It's great to see you in the studio.
Great to be here. Thank you.
So let's start with the Fed. Everyone and their aunt is saying that the Fed is going to cut rates this afternoon, but you take a look at the numbers in isolation. You have headline inflation at 2.6% on an annualized basis, the unemployment rate at 4.2%. Where in this economy do you find the justification for another rate cut here?
Well, I think the real justification is if you look at core inflation measured by core CPI, we peaked at 6.6% about 2.5 years ago. We're down to 3.3. On core PCE, we're about 2.8. So you've basically cut your inflation rate in half. And you basically had Fed funds rates that were as high as 5.25 to 5.5. That seems too high when you've cut inflation as much as you have. So really the case for easing is purely that inflation has slowed substantially. To your point on labor markets, 4.2% unemployment, any economist looking back through history would say that's full employment. So there's not a worry. But when I do look at the labor market, there are signs of weakening. 2023, we created 251,000 jobs per month. First half of this year was 207,000 jobs. Second half, 148,000. You see a really clear deceleration in terms of job creation and weakening on the labor market front, which is why Jay Powell said at Jackson Hole in August, we have to think about both sides of our mandate at this point.
So you have to be careful with the details here and really take that into consideration. You said easing, and I thought that was interesting because there's this narrative out there that we're not easing. It's normalizing. How much water do you put into that?
I think it's playing with the same words. Effectively, it's basically a reduction of tightness, you might say. It's kind of going to start playing these adjectives. It gets a little challenging, but it is easing from restrictive levels. Let's put it that way. they're not at neutral yet. I think most people would say neutral is maybe a 3 to 3.5% rate. That's been evolving, by the way. If you go back a year ago, people would have said 2.5 to 3. So it's been kind of migrating higher. So I think the Fed is going to keep trying to get towards neutral over the next year, but they're going to do it very slowly. And there are a lot of wild cards that could throw them off course in 2025. I mean, this may well be the last rate cut we get through the end of 2025, depending on what comes out of D.C.
If you believe that the neutral rate is indeed higher, you say at least 3.5%, potentially it's been drifting over the past year, has the market adjusted for that potential new reality?
Well, I think the hard part is there's no clear, easy definition of what neutral is. And one of the arguments in favor of a higher neutral is, look at how strong the economy's been despite a 5.25% to 5.5% Fed funds rate. You basically had all this tightening. The Fed's balance sheet has shrunk by almost $2 trillion now, and yet the economy seems to be doing quite fine. So maybe neutral's a little higher than we thought. And I do think it's interesting looking at the long end of the curve that we now have the 10-year yield around 4.4%. I think 4.5 to 5 is probably fair value. Again, with a bias toward the upside as we move through time. Because another thing to keep in mind is, as excited as the market is about a Trump 2.0, when Trump got elected the first time, government debt to GDP was 73% or 76%. Today, we're at 106%. So we've got a much higher level of government debt. We're still running very large deficits. These interest rates are likely to grind higher.
What's the biggest problem here of a market that is seeing the Fed try to control the short end, but really see the long end taper off? Is there a problem here when you can't control the long end and that drives so many other types of interest rates, mortgages and otherwise higher?
I think it's a real challenge. And it's interesting, by the way, 7-8 years ago, we did a regression of 40 to 50 years of 10-year yield and the PE on the S&P 500. And the R squared was like 0.01. There was no correlation. But what was interesting, historically, when you had a high 10-year Treasury yield, it was because you had very high growth. This time, you're getting a higher Treasury yield, not because of high growth, but because of inflation and because of very high debt levels. And so I do think that old lack of correlation or lack of relationship might change now to what people have always thought it should be, which is higher rates mean lower valuation. And I think that's something the market really is not pricing right now.
Yeah, let's talk about that a little bit more. I mean, it was striking to hear you say that fair value between 4.5% and 5% on the 10-year yield, because that's around the area that people have been telling us that could be a danger zone for risk assets. So how are you thinking about that dynamic between, the equity market and a fair value Treasury yield of maybe closer to 5%?
I think it could present real challenges as we grind higher. And, Sonali brought up housing. I mean, it's going to be a real challenge for housing affordability. It's going to be a challenge for loss-making small-cap companies that need to keep borrowing money. So I do think this will be something where different parts of the market will react differently to those interest rate pressures. And so it's a dynamic I'm worried about as we move into 2025.
Glad you brought up smaller companies because Katie focuses on the Russell 2000.
They've been fascinated.
Has it for the little guys. She keeps an eye on them. And so when you think about that trade that has been building in the market in the Russell 2000, then do you think that there's a real risk in something that has become fairly crowded?
I've been positive on small cap for much of this year. It was very gratifying to see it finally work.
Yeah.
But I do worry that when you look at small cap, especially the Russell 2000, around 35% of the companies lose money. And so this interest phenomenon is really important. And part of my bullishness through much of the year was predicated on rates going down, lifting the net income after interest expense. I think the bullish case now has shifted, and it's more that 90% of revenue is domestic for the Russell 2000. If you end up in a trade war, they're less vulnerable in terms of retaliation and supply chains. And maybe there's also a view that you get an acceleration in domestic growth because of different trade policies and tax policies. Maybe there's a little too much optimism there, but I think there's a case to be made for still having some exposure in the small cap zone. Maybe better expressed through an S&P 600, where the debt criteria is different than the Russell 2000.
So basically, you're not giving up on small caps, but you're saying be choosy about the different indexes here.
I think you want to have a quality bias within small cap because, the quality of small cap compared to, say, 20, 30 years ago is lower than it was.
Yeah.
There's a lot more debt, a lot more loss-making companies. And I don't think that's where you want to be. I think you want to be in quality companies who can withstand different volatility and uncertainty in the economy.
There's a camp out there that also believes that betting on big tech is kind of like betting on long duration. Do you buy that argument? Do you think that that's a reason alone to be piling into big tech the way that people still are right now?
I can see the case for that. It makes some sense. But it's dangerous. I mean, and maybe where tech is different now, sounds like famous last words, right? But when you look back through history, many, many years ago, you might have said, well, who could ever get rid of Motorola? My flip phone is so important. Or,
Can you imagine?
Certain other kind of tech products. And they went out of style. But now there's a different ecosystem built around different tech products. And it's the foundation for so much of the economy. I could see the case for saying these are going to be resilient companies that are very safe. They've got great balance sheets in most cases. But I would be a little careful about assuming that tech will be constant for decades to come, when what we're living through right now is one of the most disruptive phases of technology in our lifetimes. Yeah. Why wouldn't that happen again in 5 to 10 years?
Ron, we thank you so much for joining us here on set. That is Lazard Chief Market Strategist Ron Temple. We're going to look at some stocks moving ahead of the opening bell. We're going to bring in Abigail Doolittle.
Let's start off with the shares of Expedia, which are popping higher in the pre-market here. Sonali up more than 3%. This is B of A has upgraded the stock to a buy from a neutral, saying that they see signs of improving trends within U.S. travel. They've also set a higher price target, $221, implying that there could be more than 20% upside potential. In addition, B of A is saying that the year-over-year comps are easier, and that could really help the stock go higher. Speaking of higher, let's take a look at the shares of Birkenstock. They are popping the better part of 10% the last time I looked, still up 8.8%. They put up a great quarter, and they're seeing very strong demand for high-end shoes, and in particular, closed-toe shoes. So they have boots on their website, and some of those shoes, those boots, closer to $400. So that is fairly high-end. And then finally, where we have a little bit of weakness, some weakness, the EV space, Tesla, which unbelievably is now up more than 90% on the year. Today, investors taking some of those chips off the table. The expectation around Tesla, of course, is that the incoming Trump administration could be helpful around regulation being lessened around the robo-taxis, and then the tax credit, the disappearance of them around EVs. The expectation is that could help Tesla, but it could certainly hurt Rivian and Lucid. We see the entire group right now, Katie, under some pressure.
Great roundup, Abigail, but I am banning, at least for a day, the term closed-toe shoes. I don't know what they are. We can just, or sandals, rather, because I feel like...
Boots would be easier, right?
Yeah, boots, heels, shoes, sneakers, yeah, clogs. In any case, Abigail, we'll see you at the market open. And coming up, Nissan and Honda exploring a merger to better compete in the global auto industry. Renault keeps the door open. We'll discuss it next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. It's more bad news for 2 NASA astronauts who have been stuck in space since June. Their mission is being extended yet again, and the pair is not expected to return back to Earth until at least late March. That would mark 10 months since they originally launched on Boeing's Starliner on June 5th. The original mission was supposed to last just 1 week. Luigi Mangione was indicted in New York on first-degree murder charges in the killing of United Healthcare CEO Brian Thompson. Prosecutors are calling the shooting a premeditated act of terrorism. If convicted, the 26-year-old would face life in prison without parole. Mangione is currently being held in Pennsylvania State Prison, but the Manhattan District Attorney said Mangione may drop his objective to extradition and could be returned to New York by the end of the week. And Bank of America CEO Brian Moynihan is hinting that he's not going anywhere. The banking boss just turned 65, but at the bank's town hall, he told the crowd that he wants to be CEO when the stock eclipses $100. Moynihan spoke to Bloomberg Wall Street Week anchor David Weston on what his future holds and where he sees banking regulations under the new Trump administration going.
One of the larger contexts is the oldest part of a company has been around for every presidential transition except for George Washington. So we've been through this before, we'll be through it again. But the real fact of the matter is, if you think about what the policies are that President-elect Trump got elected on, it's inflation and immigration stuff, but it's also about deregulation. And our industry needs to have a sober look at what the right regulation.
And that, of course, is Brian Moynihan. He is the CEO of Bank of America. But let's turn to autos in the absence of Matt Miller, because shares in Nissan surged the most in at least 5 decades after Bloomberg learned that the troubled automaker has become the largest buyout target in Japan. Nissan's biggest shareholder, Renault, is seeing its shares rise too after the news broke the French automaker is open to the two companies pursuing merger talks. Let's break it all down now with Craig Trudell. He leads our Global's autos coverage, and we'll get to the likelihood in a minute, but I want to talk about why this might make sense. You take a look at Nissan shares, at Renault shares. Clearly, this is a bit of a welcome surprise. Walk us through the logic.
Yeah, I think when you look at Nissan, this is a company that lost 2/3 of its value in the years since Carlos Ghosn was arrested, heading into last night's reports breaking that Honda would potentially merge with the company. It's long been the case that the Japanese government has been really concerned about the state of Nissan after Ghosn was unceremoniously taken out and arrested back in November of 2018. And I think all along there's been some desire to maybe try to drive Nissan into the arms of Honda, but maybe to a lesser extent of some cross shareholding, some cooperation, basically replicating what Renault and Nissan had in the good days. I think at this point Nissan is in so much trouble that may not be enough, and we'll see whether this indeed turns into a full-blown merger where Honda really comes to this company's rescue.
Oh, not to overcomplicate things here, Craig, but of course there are a lot of complications in terms of people who want to be involved in this deal, people who would have a say in a deal like this. Explain where Foxconn stands in all of this and what they would have to gain in a merger like this.
Yeah, complication is Nissan's middle name. This is a case where, Foxconn for some years now has had these ambitions to enter the auto industry. It's only seen so much growth in the electronics sector, and obviously cars would be much higher value. They've really had trouble sort of setting something up on their own, and so I think this was a case of, looking at a big legacy car maker that was really wounded and potentially could be a takeover target. I do think that, every indication we have at this point is that, these talks that have been ongoing for months about, a sort of lesser combination or joining together of Honda and Nissan, that, Foxconn's interests may have kind of spooked folks in Japan. And we do know, from the experience of Renault and Nissan that, a lot of what drove the falling apart of that alliance was sort of Japanese nationalism. And so I think that is likely, playing in here in terms of taking what was, talks that have kind of been bogged down for many months now and, leading to, potentially something much more serious and more substantial here.
Can you talk to us a bit about sort of the fundamentals of Honda? Because Nissan's troubles aside, you take a look at Honda's valuation since 2018 or so, it's pretty much stayed the same with some peaks and valleys in between. So what does the corporate health of Honda look like to take on something like this?
Yeah, Honda's kind of a plotter, if you will. I mean, they are not a particularly flashy company. I think they would bring a lot to the table for Nissan in terms of helping address the fact that Nissan has a big hole in their lineup from a perspective of hybrids, which, a couple years ago, I think everybody was sort of making these predictions that, hybrids would go away and fully electric, battery electric vehicles were the way of the future. I think we've seen a real sort of renaissance of hybrids that has really caught Nissan out in markets like the U.S., where Toyota has just not been able to keep hybrid cars in stock. Honda, is much more closely a competitor to Toyota in those segments, and Nissan is kind of nowhere. And so that would be a big, potential outcome of this is potentially, allowing for Nissan to catch up in that regard. And potentially be a half measure toward the electrification that is driving this industry in a dramatic direction.
Craig, we have less than a minute left here, but if you're an American car maker, notwithstanding the challenges that you've already outlined, how are you watching this potential deal come through and potentially competitively reacting?
Yeah, I mean, I think the short answer is, it's from tough waters to really tough waters, in the sense that you do have extremely weak Japanese yen that has benefited these companies and sort of maybe helped paper over some of their weaknesses. And so you have a really competitive and strong Toyota, a pretty strong Honda. You had a weak player in Nissan that now maybe the sort of bottom is put in. And so if you're GM or Ford, an already difficult, competitive situation, you don't necessarily have the potential for one of your competitors falling by the wayside. And this is really tough sledding for this market right now.
Craig Trudell, we thank you so very much for all of your time here. Now, coming up, we're going to shift over. We're going to talk about the AI trade because it is broadening out from a select few. Investors are rotating out of NVIDIA and into other things. Could Micron now mimic Broadcom's post-earnings rally when it reports today? We're going to discuss. This is Bloomberg.
Welcome back to Open Interest. A quick check on futures here. Now in the red, the S&P 500 flipping into negative territory. The Nasdaq 100 down about 0.1%. Small caps hanging on and then some. The Russell 2000 up about 0.6%. We do have earnings after the bell on this Fed day. I want to talk about Micron. If you take a look at the year-to-date chart of this stock, it has been a wild ride. It's up about 29% on a year-to-date basis, but you take a look at that big decline from June, of course, those peaks. It's been pretty bumpy. Of course, analysts will be examining these results for any information on the high bandwidth memory products after the bell. Of course, the end market there is PCs and smartphones, and we know that's been choppy territory.
Yeah, it's interesting to see it rising today. You think about the consensus views here. Bloomberg Intelligence, for example, says that they expect Q1 revenue at the midpoint of guidance. So it's not expected to be gangbusters.
Yeah.
But there's already some of this priced into, remember, NVIDIA's report had boded well for Micron already to some investors when you think about that high bandwidth memory that was expected.
We know there's plenty of AI demand out there. It's what these different companies are doing to monetize it. So all eyes on Micron and all eyes on the Fed and all eyes on the opening bell. Coming up next, this is Bloomberg. All right, we are moments away from the start of trading on this Fed day, the final Fed day of the year. Welcome to Bloomberg Open Interest. I'm Katie Greifeld. You can see that markets aren't exactly celebrating the final Fed day of 2024. A lot of questions, not about what they're going to do this afternoon. We know that they're going to cut rates, but what they do in 2025, that is an open question, and that is what investors are asking themselves heading into 2 p.m. and then Powell's big performance coming up at 2:30. But in the meantime, of course, the bells are ringing. The market is opening. You can see down at the New York Stock Exchange, Brazil Potash is ringing the bell. Over on the NASDAQ market site, Ocean First Financial. Let's take a look at these indexes. Just about 18 seconds into the trade, you can see a pretty quiet start. The S&P 500 just about unchanged, maybe to the red. We are just about flat on this week. We'll see how the dynamic changes, of course, after 2 p.m. You take a look at the NASDAQ 100. We were higher pre-market. Not the case anymore. Big tech index down a little bit. And then the Russell 2000, the small caps holding in there. We'll, of course, see how that changes when we get Powell's maybe thoughts, maybe predictions on how next year is going to go when it comes to the rate cut trajectory. But in any case, the Russell 2000 up about 0.5%. Let's get specific here, though, and let's talk about NVIDIA. It's rebounding a little bit from its October lows this morning. Remember, the stock entered into correction tory this week as investors broaden out AI bets from the Magnificent Seven. We were just talking about Micron, of course, reporting after the bell.
Yeah, let's talk a little bit about that because it is moving as well, getting specific in that AI trade. Micron up about 1.6% as the market opens. Shares are up 27% this year, and the street expects this quarter to be the strongest quarter of earnings expansion in years. Finally, we're also watching General Mills because it is still earnings season and it has turned lower after tweaking its full year sales forecast to the lower end of guidance. Adjusted earnings per share did beat estimates in the prior quarter, but you're still seeing General Mills down 4.4% as the market opens. We're going to get a closer look at General Mills with Bloomberg's Abigail Doolittle.
Yeah, and here's this guidance that you were just talking about, Chanel. You can see that it had been positive for year after year, and now for the estimated 2025, we're looking at the possibility of a low single-digit growth decline for earnings. So, in the context of the quarter, that was a beat. One analyst saying that has to do with the timing of Thanksgiving. Now we're seeing the other side of that. And the new targeting at the lower end of the old range, and we now have the new range, has everything to do with price cuts. So investors not really liking this all that much. We can see, though, it's not coming as that much of a surprise, despite the fact that the quarter that was good. If we take a look at the stock from September, we are going to see a pretty healthy decline here of about 16% today, a dip on the year, now slightly lower. Let's put this stock, this consumer stock, into the context of some of the other food stocks, and we're going to see that it's pretty much chugging along with the other ones, such as Conagra, Campbell's Soup. One that's clearly underperforming, Mondelez. And what makes this really interesting, Katie, is apparently, according to Jen Bartauschis, our BI analyst, the future is very, very bright for Mondelez, especially the potential acquisition of Hershey and their interest in chocolate. But because of the record high cocoa prices, 2025 could come under some pressure.
Yeah, it's really interesting to see all those lines pretty much trending down over the past several months of 2024. Great roundup, as always. That is Abigail Doolittle. Meanwhile, let's broaden out this conversation and let's bring in State Street Head of Equity Research, Marija Veitmane. Of course, it is Fed Day. It is maybe the last day that matters in 2024. And we'll get to the Fed, but I want to talk about basically this fizzling out that we've seen of all of these high conviction trades that came into being after the election. You think about the small caps, for example, you think about basically everything but tech catching a bid. It feels like that's fallen apart in the last several weeks, Marija, and I wonder what you make of it.
Yes, hello. I think the key drivers this year has been like kind of twofold. We had start of rate cutting cycle. That's your beta. That's why market's gone up. But relative trade has all been predicated on better earnings. And market is really reluctant to give the benefit of the doubt to companies or sectors or styles that don't have good earnings yet and expected to do better. And I think small cap is really a kind of a poster child for that trade, where kind of current economic fundamentals are really challenging. Almost a quarter of companies are loss making, margins are tiny, cost of funding is huge. So that's a difficult situation. Yes, potentially with more like growth friendly environment, they might grow, but market wants to see profits now, and that's really hard to find outside tech, and hence kind of this kind of imbalance between the market. Tech does well, quality large caps doing well. Everything that hasn't got growth yet is really struggling.
So do you follow that trade then? Do you just stick with tech and enjoy the momentum, or do you sort of swim against the tide here?
I mean, I have to say, I love tech, and I loved it for many, many years. I think the narrative around tech has changed a little bit. So we used to like it for beta, for cyclicality, for like low, for duration when interest rates were very low. Now, what we love tech for now is quality, size, low leverage, strong cash flows. So those things we love about tech, and it's really hard to find them anywhere else. So yes, we're sticking with tech trend, absolutely. I mean, we may be kind of changing the justification around it a little bit.
When you look at the 10-year drifting higher, now just around 4.4%, at what point does that drift higher make you think differently about the discount rates that you're seeing in tech? Is there anything that's completely immune to that move?
I think there is a little bit about beta for the market in terms of kind of overall higher interest rates. I mean, not great for the whole market, but I would probably argue they're a lot worse for kind of small caps or companies that really rely on, like highly levered companies that rely on this kind of cost of borrowing is like important part for them. For tech, I mean, arguably you can say they're actually making money on their enormous cash balances. So higher interest rates is not necessarily detrimental for them. So if you're thinking about kind of relative trade, then I think tech is a bit more immune than lots of other sectors, lots of cyclical sectors or smaller cap companies.
How do you position around tech at this point in time? The thing that Katie and I were talking about a little earlier is how much of the market is looking at some of those big run-ups you've seen, say in NVIDIA, and start to look at other options when it comes to artificial intelligence. How do you make those choices at the end of the day? Do you like to stay in pure play AI and start to think about what might take a little longer to catch up to those valuations because you could buy it a little cheaper right now?
Well, I have to say, I mean, valuation is like a great concept in the long run, and we know that value kind of in theory should work by cheap. What we're seeing now is momentum trade. I mean, value has underperformed growth for like over a decade now, and I think what's really important and point like in a cycle when earnings are much more difficult to come by is to pay, as investors have to pay higher multiples for those stronger earnings, and that's really tech, that's really AI. So I mean, we don't go down to stock level, but kind of sector wise, it's still kind of broad-based tech trades that is dominating.
And Marija, given that it is Fed Day, I'm curious how you knit together, of course, the macro backdrop with perhaps some of the fiscal and some of the fundamental earnings that we were talking about. We were just having a conversation with Ron Temple at the top of the hour, who said that depending on what happens in Washington, the Fed might not be able to cut at all in 2025. What would that mean for this tech sector that you feel pretty good about?
Yeah, I think it's really interesting dynamic. So for now, I mean, I feel for Fed and Chairman Powell. I mean, they don't know what kind of new administration policy would be. So for them, it's really hard to kind of design policy around the kind of unknown and uncertainty. And we've already seen some signs that all this really, really tough tariff talk is kind of a tool to achieve goals that like administration pursuing. So we really don't know. I think the very interesting tell would be what they do with their PCE estimate in the next year. So if they really increase their PCE forecast, that's probably a kind of a good tell that they think that whatever happens with new policy would be very inflationary, and they will have to react to it. If they don't, I think that would be a good sign that they feel fairly comfortable with the path of inflation and kind of the general glide lower in terms of policy rates.
What do you make of this argument that the neutral rate has been drifting higher? We were talking to Ron Temple over at Lazard a little earlier, and his estimation was closer to 3.5%. And if you believe that, then has the market adjusted to that reality? And how long will it take if not?
That's a really difficult question, of course. I mean, neutral rate is something we know in hindsight, but I think markets seem to be taking this in a good stride. We haven't seen really huge increase in break-even rates, so market is really not panicking. They feel like inflation is anchored. We have a really good estimation of kind of current online prices, so we kind of scrape prices of internet, see how online prices are changing. There is very little signs that there is any sign of panic, prices increasing and things like that. So for now, we see like inflation expectations really being fairly anchored, and kind of markets feels to be quite relaxed about it. So I don't think we kind of focus on it too much. We need to focus on it too much yet.
State Street Head of Equity Research, Marija Veitmane, thank you so very much for your time today. Of course, a big day with the Federal Reserve. And Katie, it's really interesting because you're looking at the S&P 500. The trade has been tough the last couple of days. But as our producer, Dan Curtis, points out, there's a breadth reversal underway. What we said at the top of the show, you're starting to see it break down a little bit. Even though the S&P is down, 60% of the stocks are higher.
Yeah, I wonder how seriously, though, you can take any move on December 18th. Of course, it is the last day that matters. We do have the Fed this afternoon. We have some interesting earnings, but kind of in silly season. Silly season, but we are getting off of kind of record low lack of breath here. So notable, nonetheless. Yeah. Anyways, we're paying attention. Now, coming up, more on the Fed as well as private markets. We're going to bring in for that Bruce Richards of Marathon Asset Management. You're going to want to stick with us for that. This is Bloomberg.
This is Bloomberg Open Interest. I'm Abigail Doolittle in the principal room. Coming up at 10:30 a.m. Eastern, an interview with Michael Saylor, co-founder and chairman of MicroStrategy. This is Bloomberg.
And it's time now for the Wall Street Beat. Bond traders are boosting wagers that the Fed is about to signal deeper interest rate cuts next year than the market anticipates. Wall Street is preparing for a potential rate pause in January. We're going to talk about those implications on private markets and public credit markets with Marathon Asset Management CEO Bruce Richards. You have still inflation above the Fed's target, yet the market is expecting another cut. What does that mean to you in terms of the trajectory of inflation going into a bigger easing cycle ahead, even if that easing cycle is less than initially expected?
Hi, Sonali. Great question to open with. So 43 straight months, core CPI is above 3%. 43 straight months is rather remarkable. We haven't seen a stretch like this in a really long time. In the last 3 months, 3.3% is the number. And so the Fed, Powell won't tell us this, but they've given up on 2%. They've given up on 2 because they know the number's 3. And they know tariffs are coming, and so that's going to keep it firm. They know pro-economic policies are coming, less regulation, and so that's going to keep it firm. They know it's not going back down to 2. They can't tell us that. So what they're going to tell us in today's Fed meeting is they're cutting rates 25 basis points. And so from September 18th to December 18th today, exactly 3 months, they will have reduced rates 100 basis points. Probably a bit much given growth is above 3% this quarter, GDP expected by the Fed, and given where inflation is. And so I think we'll see the dot plot go from 4 today, where it was previously, to 3. Next year you have 8 meetings. There's only going to be 2, maybe 3 cuts next year. And so most of the time they're going to be in pause, and that's going to keep the markets anxious next year because most of the times they won't be easing, and the markets really like to see an ease.
So what does this mean in terms of the trajectory of inflation next year? If you're a fixed income investor, inflation is killer. And so do you expect that it's going to be higher than anticipated? And do you fear, like some investors do, of a 70s style repeat?
I believe that the R-star, the real rate of rates is going to be higher. The nominal rate's going to be higher. The Fed has lowered rates after today 100 basis points, yet the 10-year note's gone up 75 basis points. And so the markets, the bond markets, aren't believing the Fed's language as it relates to inflation. They take what the Fed gives them in terms of the Fed easing. Equity markets love it. Debt markets love it. It's great for the economy, but real rates are higher.
Well, I think that's so interesting. You mentioned, of course, at 2 p.m. today, we'll have had 100 basis points of easing. The long end has just been, it's been shocking to see that move. And, you talk through the reasoning why it could be happening. But what does it mean for other asset classes? When does the equity market wake up to the fact that the long end is saying, hello, look at the trajectory of where things are going?
Well, the first thing it means is, and we haven't seen front rates come down 50 or 100 basis points and long rates go up by 50 to 100 basis points. We haven't seen this dynamic since 1990s. It's not happened since then. And what happened then was the economy was strong. That's why rates were going up. Yet the Fed was easing. And so what happened? Credit spreads went to their tightest levels ever. This is investment grade, triple Bs, double Bs, high yield, all to their tightest levels ever. So what we're going to, and it stayed there for a year and a half.
Yeah.
So what we're going to see, the first knock on, is the economy's doing well, earnings are doing well, and so corporate credit spreads are going to tighten in, but yet you can earn a 7% in liquid markets in both high yield and other structured credit instruments that are non-investment grade. And so it's a good rate, but yet it's a really tight spread because the credit risk is being mitigated now.
Well, that's what's happening now, right? I mean, you have credit spreads across the spectrum at very, very tight levels. And you put it all together, you could make a case for backing up the truck on investment grade and on junk. Are you making that case?
Well, we've been buying and we'll continue to buy. And I think that you'll have a low volatility environment for those types of assets. And so do you want to back up the truck now? I think you want to be equal weight now. But I think that within your kind of fixed income allocation, you want a nice, healthy allocation because I think the risk factor's down. The risk factor's being credit risk, and you're getting paid an average yield despite what's a tight spread.
So how do you invest through all of this at the end of the day? This is the setup. You believe that the rate is higher at the end of the day. You are seeing that divergence that you haven't seen since the 90s. What do you do with that?
Well, first of all, I think it starts, Sonali, with the 60-40 model, right? And the 60-40 model is alive and well. And it's how every investor, whether you're a wealth investor in high net worth or whether you're an institutional investor, should think about investing, the 60-40 model. And so within the 60, that's equities, and that's public equities, and that's how we think about it traditionally. But public equities have just had back-to-back years of 25% plus gains. You've only had that twice in the 90s and the 1950s. And so it's probably not going to be repeated next year because we brought forward some of this price action. And so I think this is the time where you want to say, okay, equities will make a 7% return, our historical return, and we'll really want to lean into private equity. And so think about public and private equity for the 60% model is how you want to think about that.
Bruce, we only have time for one more question left here, but you said this thing in the commercial break that I really want to get to. You told us you think Basel III Endgame is dead. You think that has serious implications for credit markets. Your conversations with the banks right now, bring us inside of them and what that says about where the direction is going.
I do believe that Basel III Endgame is dead because I believe part of the regulations that we're going to see, the regulatory relief that we're going to see, is going to also transform into what's happening in the banking system. Rather than have these onerous rules placed yet on the banks, I think the conversations that Jamie Dimon and Donald Trump and other people in the administration, incoming administration, have with the bankers will lead to that. And I know the Fed and Vice Chairman Barr has a lot to say about this, but I believe it's dead. And so what that means, it means the CET1 ratios of the banks, which are pretty strong and pretty large, it's going to unleash a lot of ability for the banks to be able to lend. The number one place they're going to lend to is they'll lend across the board, but they'll lend loan on loan. And so folks like Marathon will get really attractive financing from the banking system, and that attractive financing in the form of lower rates that we're going to be borrowing at will help drive our private credit returns. And so the 40 model, getting back to 60-40, is not only 40% fixed income, but half of that should be in private credit. Direct lending, we're seeing twice the deal flow that we're seeing today, now, this past quarter, than we did in the whole last year. And asset-based lending is alive and well and taking off in a big way. And having that financing available from the banks is a big boon to all of us in the private credit markets.
All right, Bruce, come back in 2025, will you?
Definitely.
All right. Happy holidays when you get there. It's great to see you.
Sonali,
we really covered a lot, so look forward to speaking again. That is Bruce Richards. He is the CEO of Marathon. And I said that it was the final day that matters, and I was half joking, half not, though. I get an email from Steve Sosnick over at Interactive Brokers. He says, no, it's Friday. We have that major NASDAQ 100 rebalance coinciding with the triple witching, so could expect some fireworks.
And you have the perfect guest to talk about it. You're bringing in Michael Saylor in the next hour as well. He knows a thing or two about that rebalancing.
That's true. Of course, MicroStrategy added to the NASDAQ 100. That will take effect on Monday. Really looking forward to that conversation coming up at 10:30. But coming up before then, Barclays getting bearish on oil. We'll have all the top calls next. This is Bloomberg. All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Barclays cutting its recommendation on the energy services sector, downgrading Halliburton to neutral, saying it's no longer a buy. The firm also says that global spending in oil services projected to be flat next year with downside risk ahead. Next up, we have Evercore ISI upgrading Dow to a buy. The analyst says that the company's prospects for 2025 are, quote, less bad, and he sees an attractive opportunity. Shares up about 1.1%. And finally, we have Baird cutting Rivian, saying it's no longer a buy. The firm cites a fast-changing geopolitical landscape. You can say that again. The analyst also says that Rivian has few catalysts in the new year. He also expects EV sales to languish. It has been a really interesting, a really volatile ride for Rivian and really a lot of its peers, including Tesla. Rivian down about 2.9%. Meanwhile, let's get a check on this stock market. Of course, we are awaiting the Fed coming up at 2 p.m. today. You have the trade that'll take place at 2 p.m. and then you have the reversal, of course, when Jerome Powell starts speaking at 2:30. But in any case, here's the setup heading in. You can see the S&P 500. It's pretty much flat on the day, which means it's flat on the week. It is green, though. You take a look at the NASDAQ 100, a little bit lower, a touch to the downside here, down about 0.1%. And then you have the Russell 2000, the little guys, your big leader, at least for right now, the Russell 2000 up about 0.4%. Now, coming up in the next hour, Michael Saylor joins the show to talk about MicroStrategy's Bitcoin buying and how he's preparing for 2025. Don't go anywhere. This is Bloomberg. All right, we are 30 minutes into the trading day on this Fed Day Wednesday. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and coming up, the final countdown. Powell and his colleagues are set to deliver another quarter-point rate cut today at their last meeting of 2024. And with that decision upon us, we're going to discuss the implications for market, real estate, and more with David Rosenberg of Rosenberg Research and Bess Freedman of Brown Harris Stevens. Plus, MicroStrategy's momentum. We're going to speak to the man at the center of one of the most important investment stories of the year, Michael Saylor, chairman of the biggest corporate buyer of Bitcoin, joining us in the C-suite.
And before we get there, we do have some breaking news here. This coming from California. The California gas car ban wins Biden's blessing in, of course, a clash with President-elect Donald Trump. Let me bring you some more detail here. The Biden administration has authorized California regulations that compel the sale of zero-emission vehicles over the next decade and ultimately ban the sale of conventional gasoline-powered cars in 2035. Remember, of course, President-elect Trump has vowed to terminate EV mandates, and his administration is expected to swiftly seek to revoke the approval. So we'll see, of course, what happens there. But just to reiterate that headline, California gas car ban wins Biden blessing in clash with Trump. You can see not too much reaction when it comes to some of the car and automakers there. Tesla shares currently down about 2%, Sonali.
And the latest Fed decision, as we've been talking about, is due at 2 p.m. Eastern time, the big moment of the week. We're going to get insight from Bloomberg's Michael McKee in D.C. What are you expecting? We were talking all week about what would surprise the markets, but at the end of the day, there's still a lot of uncertainty out there on the path ahead, isn't there?
There is uncertainty, although we narrow it down a little bit. At 2 o'clock, you'll hear me come out and say the Fed cut rates by 25 basis points. That's not going to be a surprise to anybody. They basically signaled that going into their quiet period, and there hasn't been any kind of leak or anything that would suggest that's not going to happen. The real question is, what happens next? Are they signaling a pause, or are they signaling that they will continue? In the statement, there is a phrase that says, in considering additional adjustments, the committee will look at this, that, and the other thing. If they put in considering any additional adjustments, that might be a pause signal. Then, of course, we get the summaries of economic projections, each of their views on what growth, unemployment, and inflation will be, along with the neutral rate. And that will tell us something about whether they think they need to pause, because if inflation is marked up, that would signal some concern there. And finally, the dot plot, of course, everybody's going to be looking like at the end of the book to see who did it when you skip through a mystery. Everybody will look at the dot plot and try to figure out how many rate cuts are we going to see next year. In September, the Fed's forecast was for 4. The view is they'll cut that back, but how many do they come up with? Is it going to be 3? Is it going to be 2? Or do they signal even 1? That would probably be a surprise to the markets. But those are the things that the markets are going to be looking for today.
Yeah, and it's safe to say we'll all be seeing dots this afternoon. Looking forward to seeing you at 2 p.m. and, of course, in that press conference. That is Bloomberg's Mike McKee joining us from D.C. And, of course, special coverage of The Fed Decides. It starts at 1:30 p.m. New York time on Bloomberg Television. Let's keep the conversation going now with David Rosenberg. He is Rosenberg Research Founder and President. Great to have you with us on the final Fed day of 2024, David. I want to start with a question I asked to Ron Temple exactly an hour ago, and that is that you have inflation at 2.7%. You have the unemployment rate at 4.2%. What is the case for cutting rates right now?
Well, there probably isn't a strong case right now for cutting rates, but the Fed boxed itself in for today's meeting quite a while ago, and there's probably collective regret for doing that. But, you know, the Fed doesn't like to surprise the market, so I'd expect that they'll cut rates 25, but it's likely going to be rather hawkish on the statement, the tone from Powell, the dot plots, everything else beyond the move today. But I would tend to agree that there isn't a strong case right now for a rate cut as of today.
David, is it an admission by some regard here, that the neutral rate is actually higher than what has been communicated?
Well, so the neutral rate, you could argue, is higher than commonly expected because the economy hasn't really throttled back with what was the Volcker-esque type of monetary policy tightening cycle that we had in 2022 and 2023. That said, we had tremendous fiscal stimulus in that period. And when you're taking a look, I mean, we all talk about AI, and we could talk about the wealth effect of the consumer, but the fastest growing component of the U.S. economy is government spending. And, we just got the budget numbers for the first 2 months of the fiscal year, October, November. Government spending, excluding interest costs, so program spending is up 20% year over year. So if we start to see a semblance of sanity return to Washington, and we'll see what happens, then I expect that the fiscal policy stimulus is going to subside, and the economy is not going to be nearly as robust as it's been over the course of the past couple of years. Well, so I have an open mind towards where neutral is. Where people think neutral is today might not be where they think neutral is going to be 12 months from now.
I want to explore the fiscal side of the equation a little bit more, of course. A lot of big ifs out there, but often when we talk to people about what the economic outlook for 2025 is, the wild cards such as tariffs and tax cuts come up. How do you see the Fed navigating through those cross currents as they try to execute on monetary policy without being influenced too much by what's going on in Washington?
Well, the outlook is definitely clouded. And I think what you're going to hear from the Fed today is one word over and over again, which is cautious. I think that they're going to express caution. I don't think they're going to suggest at all that they're going to raise rates. I don't think that they're going to signal that they're going to be in a pause period indefinitely. So I think that the trajectory will still be down, but it's a matter of timing and magnitude. The tariffs, that's a two-edged sword because, you just heard from the Premier of Ontario that Trump brings on these tariffs against Canada. Well, bye-bye electricity exports from Ontario to the U.S. And not just that, but oil, natural gas, critical minerals. Like, the thing is that it's a slippery slope. I know that Donald Trump thinks that tariffs are a beautiful thing until you get retaliation. And it might not hit the consumer. Canada's a small country, but Canada's exports to the U.S. is very vital to U.S. industry. And so it's a double-edged sword. The tariffs he doesn't need Congress for. He could just wave his magic wand, but it's uncertain as to what the overall economic impact is going to be. It's really a zero-sum game. If anything, everybody comes out a loser. You mentioned the tax cuts. Mm-hmm. Well, let's see. Well, firstly, they got to get the tax cuts from 2017. They have to, they're about to sunset in 2026. Right. He has to make sure that relief gets extended. Point number one, probably will. However, the view that we're going to get big tax cuts through the 37-member Freedom Caucus, do you think that's going to happen? I think the House Republicans are very hawkish on the fiscal side. I think people that think that there's going to be stimulus from taxation. No, I don't see that. I think we'll avoid a fiscal cliff by the extension of the 2017 tax cuts. And then we're going to have the, Elon Musk trimming as much fat out of the government that he possibly can. So I actually think when you mentioned tax cuts, no, I think 2025 is going to be a year of more fiscal restraint and fiscal stimulus. David, that's going to come down to where your view of the neutral rate is going to be by the end of next year.
Absolutely. But, I want to focus in a little bit more on what the Fed can control, right? Because there's what happens in Washington in terms of fiscal policy, and then there's monetary policy. And how much control really does the Fed have, particularly over the long term? Because you're looking here at a balance sheet that's still about $6.9 trillion at the Federal Reserve. It's almost like every time they've tried to lift their foot off the pedal, there has been a tantrum, and the long end has not been something that they've been able to control, seemingly, at least not more recently. How do you navigate that?
Well, I'm not so sure about that. The most important determinant of rates out the curve is actually the expectations of what the Fed's going to be doing. And, everybody talks about that. Look, they cut rates 50 basis points in September. Look what the the Treasury market out, the curve is done. They clearly bungled it. No, that was actually a fairly hawkish cut. That 50 basis points was accompanied by, a rhetoric that had the markets rethinking what they were going to do in 2025. That got the ball rolling on, it's curious that words matter, not just actions, as we're going to see today. So the Fed talked the market out of pricing in all those aggressive rate cuts for 2025. The next thing you know, that rise in the term premium gravitates right out to the long end of the curve. And it's no different than what happened, at the beginning of this year. If you remember, we had a temper tantrum by the bond market. Bond yields peaked, 10-year yields peaked at 470 in April. We had a monumental increase from December. Exactly a year ago, the markets thought that the Fed was going to turn dovish, which inevitably it did. But then all of a sudden, you had Powell talking about, we got these insurance premiums and health insurance premiums. Inflation is bumpy right now. We're not going to do anything. And so back in the opening months of last year, because the Fed turned more hawkish, the bond market got crushed. So I don't think the Fed's lost control of anything. They basically may be easing now, and they're going to ease today, but all anybody's going to care about is whether or not we're going to get any cuts at all next year. So it's all about the forward guidance. And I want to tell you, if you think the Fed has lost control of the curve, okay, if they sound hawkish today, Treasury yields are going to go a lot higher. And if they actually go to 3 cuts on the dot plots and not 2, which is now priced in, you're going to have a nice rally in the bond market. So this view that the Fed's lost control of anything, to me, is totally ridiculous.
All right, so it all comes back to that dot plot, it sounds like. David, we have to leave it there. Hope to speak to you again soon. That is David Rosenberg of Rosenberg Research. Now, coming up, Bess Freedman, Brown Harris Stevens CEO. She'll join us next to discuss how today's rate decision could impact next year's housing market. Certainly a hot topic of conversation. This is Bloomberg.
U.S. new home construction unexpectedly fell in November. Inventory now stands at the highest level in nearly 17 years. High borrowing costs have constrained demand for the sector, even as the Fed is expected to lower their benchmark rate for a 4th straight time this afternoon. Joining us now, Bess Freedman, CEO of luxury real estate brokerage Brown Harris Stevens, and how frustrating this housing market has been, both when it comes to buying and when it comes to rentals. The reality of it is mortgage rates are perhaps a lot more anchored to both spreads and those longer-term interest rates, which you have not seen budge enough lower. So how do you think this is going to play out at the end of the day in terms of the reopening of this housing market?
Look, we know that 2024 was no bueno, right? It was a really bad market, slow. I think it was the worst since, they said 1996, we hadn't seen a market that slow. And so what I'm hoping for as we enter 2025 is that rates start to come down a little bit, people start to get more into the market, inflation, the economy remains steady, and we get more supply, because the real issue here is one of supply. There was an article in the Journal today about this global housing crisis that people, adults, the ages of 20 to 34, almost 60% of them in Ireland are living with their parents. And, home buying, home renting has become unaffordable in the U.S. as well. So this means we need more supply. We need to get young people into the market. And so we need to get local and state working with us so that we can have reasonable laws so that we can build. We're desperate for that.
Yeah, well, there's a lot to dig into there, especially on the rental side of things, I find fascinating. But the question we've been asking when it comes to real estate is, how much do you need to see from the Fed? Do you need to see rates come lower to really start to unlock things? We'll have 100 basis points of easing as of 2 p.m. this afternoon. What sort of threshold, though, are you thinking about?
I mean, it's hard. So I read something where it said if people see the 30-year go into the zone of in the 5s, then that would inspire sellers to put their homes on the market because they've been waiting because they have a 2 or 3%. And that would get buyers more into the market. So that's what I'm hearing or read in studies. But you don't know. I think people have felt like they want to wait. There's been these golden handcuffs. They have lower rates. Buyers don't know if they can afford it. It's not just the rates, even though that's really important. It's also that it's become unaffordable. Young people, like we just talked about, can't buy a home. They just are completely priced out.
I think also, and I'm going to ask you a bit of an unfair question because it'll be asking you to pull out your crystal ball.
Yes.
A lot of people are afraid now because if they sell their home, are they going to get a much higher price for it, or is it going to reset the market lower? That's the question still. Are housing prices going that much higher?
It depends. First of all, as we know, all real estate is local. So it depends on where you are and what the demand is. I'll give you an example. A place like Palm Beach, you put something on the market, there is a swarm of people who want to buy it, but that's obviously typically more high-end, more expensive. Connecticut, there's no supply. So when people put their homes on the market, there's a rush of people to line up to bid on the homes. So I think once we have more supply, then we're going to get prices to come down. And if sellers start to put their homes on the market and buyers get into the market, we start to see fluidness and supply and demand intersect, which is a healthy housing market, which we didn't have in 2024.
Well, you talk about Palm Beach, you talk about Connecticut. I'm going to be selfish and ask about Manhattan. What does the supply picture look like there, and how does that feed into the pricing dynamic?
We have a decent supply. You know, the market in the city has been pretty flat. High end has done well, which it usually does because it's discretionary. I mean, look at Wall Street. The bonuses are going to be incredible. You know, a lot of people are saying the stock market is obviously pushes or drives the real estate market here, and it's been very frothy. And people are saying, is there a bubble coming? Do we know? I don't. It's unclear to us. But I do think that, you know, it's been moderate. It's been decent. I would like to see a pickup in that market. There's been a big portion of this market that's been cash. So remember, the mortgage rates don't necessarily impact our buyers and sellers as much, although it does play into it.
When you think about that tension, that push-pull between renting and buying, I feel like you're so close to the ground where you see people making that decision in real time. What are they choosing at this point in time? Is there a reason to wait to buy and rent for now instead?
I think, you know, it's like they say renting is more like dating. It's temporary. And so if you don't like it, I have a friend who's renting right now on the Upper East Side, a one-bedroom. She doesn't like the neighborhood. She's like, I'm definitely moving out. It's sort of like you're dating before you get married, right? And so I think if you want to commit to economic security and building intergenerational wealth, you buy a home. Because if the stock market plummets and your coinage goes way down, you know that you're looking at your portfolio and go, damn, I have less money. This stinks. Versus if you bought a home and that value goes down, you have a roof over your head, you have a place where you can eat, sleep, have dinner, have fun, and it goes up in value. So I think that we have to think about the housing market as a long-term investment, and it is still the American dream. It's a commitment to your future. And so I'd like to get young people in the mindset of buying a home because it's an investment for your long term.
Well, I must have commitment issues because my husband and I have been in our rental building for 8 years, which is pretty amazing. But we're doing what I think you're not supposed to do, which is time the market, basically wait for mortgage rates to come down and then maybe look. Is that bad? Can you give me some advice?
Yes.
Should we just make the jump? How terrible is it to time the market?
I think the smartest person in the world cannot time the market. There's no such thing because when it's bottom, you don't know it's bottom till it's past that. So I would just say, look for something that makes sense to you, that you like. You know, I think it was Munger who said you have to fish where the fish are. And then he said a great investor fishes where there's no fishing boats.
It's hilarious. I must be like starving for commitment because I keep on looking at houses in the Hudson Valley and seeing that 300,000 point price drop.
The prices are crazy there because there's no inventory. But New York City, you can actually negotiate and find something. So I would encourage you, just going back to you because you've been renting, which is fine. You know, New York is really a city of renters. Is to start to look for something because you can negotiate and you can find something great and then you can make it your own and renovate it. And it's, you know, where you live. It's where you have everything. It's sacred space.
That's where I raised my cat.
That's what I'm saying. You raise your cat, your animals, and you have your friends over.
We have less than a minute left here, though, but with prices this high, I mean, I guess I still have to ask why buy? Because if you are worried about that price declining, then why not wait?
Because the market is cyclical. And like I just said, so if you put your money, if you have a little bit of money, you put it in the stock market and it goes down, you just have less money realized, right? But if you buy a home and it goes down, you know, the market's going to pick back up again and at least you have shelter. So I think buying a home makes sense for the long term if you can do it. Not everybody can.
All right, Bess, keep in touch. Happy holidays. Hope to see you in 2025.
Great to see you.
That, of course, is Brown Harris Stevens, CEO, Bess Freedman. Now, still ahead, Walmart is testing out body cams for some employees. We'll tell you why next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Walmart says it's testing body cameras on some store employees. It's a move that comes after some of its stores have experienced shootings and other violent incidents. Now, the body cameras are part of a pilot program that Walmart says is focused on employee safety rather than theft prevention. Next up, we have Frontier Airlines announcing an all-you-can-fly pass that would give travelers unlimited flights to domestic and international destinations. The limited time offer is available for just under $300 a year that will automatically renew at $700 a year. And finally, General Mills is lowering its profit outlook for next year. The maker of Lucky Charms and Bisquick pancake mix did beat analyst forecasts in the latest quarter, but the company says it will need to boost promotions in order to juice sales in 2025. Shoppers buying fewer items at the supermarket after years of price increases. Shares on General Mills down almost 3%. It's now negative for 2024. Let's get a check on these broader markets right now. Of course, it is Fed Day, maybe the last day that matters. I know there's some controversy there, but you can see the S&P 500 posting slight gains right now, up about 0.1%. I can't say the same for big tech. The Nasdaq 100 currently down about 0.1%. The bond market relatively well behaved right now. The 10-year yield flat on the day, but that's a board you want to watch, of course, when we get that Fed decision at 2 p.m. today. But coming up, before we get there, Michael Saylor's MicroStrategy is sitting on around $45 billion of Bitcoin. We'll discuss how he buys it, the firm's inclusion in the Nasdaq 100, and what he's preparing for in 2025 up next. This is Bloomberg. We welcome now our Bloomberg TV and radio audiences, and MicroStrategy still buying Bitcoin amid the token's record run. It's bought the digital currency for 6 straight weeks, bringing its total haul to $45 billion. And that's all before MicroStrategy joins the Nasdaq 100 index next week. Now, the company's share price is outperforming Bitcoin itself this year as retail traders and hedge funds pile in and capitalize on the volatility. I'm pleased to say that we're joined now by MicroStrategy co-founder and executive chairman Michael Saylor. And of course, we're going to get to the Bitcoin purchases, but I actually want to start with the politics of it all, because you've been relatively less vocal than some of your peers in the crypto community about your political views. And I have to ask, have you met with President-elect Donald Trump?
I've met with a lot of people in the incoming administration, but I couldn't comment further than that.
Okay, can't comment further than that. I was going to ask you about plans, but instead I'll ask you about whether or not you would be willing to serve in the Trump administration in any capacity. Bloomberg has reported that there potentially could be a crypto advisory council. Is that something that you might be interested in?
You know, I'm always willing to provide, thoughts on constructive digital assets policy, either in confidence or publicly. And if I'm asked to serve on some sort of digital assets advisory council, I'm probably would do so, yes.
Michael, I also want to talk to you about MicroStrategy, your own plans. It's amazing. You have announced plans to raise $42 billion over 3 years. You announced that back in October. But the rate you're going at, and this is through convertible debt offerings, stock sales, the rate you're going at, you could fulfill that target by January. Are you planning to lift that cap and line up more facilities in the pursuit of more Bitcoin?
Yeah, when we announced it, it wasn't clear how enthusiastic the capital markets would be, but we got a very enthusiastic reception. And then after November 5th with the red wave, we saw a big sea change in the political environment. And so we went faster than we had thought we were going to go on October 30th. Our goal is to continue to raise capital primarily through fixed income markets. So we'll pursue preferred stock or convertible bond or other equity-linked financings, as long as it's creative for our shareholders. When we get through the 21 plan, which is $42 billion in capital, we'll revisit our capital plan, and we'll put in place a new plan subject to market conditions at the time.
All right, so we'll look forward to that. I am curious, with what you've raised so far, it seems like you've been tapping the market facility more so than converts in order to raise cash. And I'm wondering if there's anything to read into that.
Well, just the equity capital markets were very enthusiastic over the past 4 weeks. And so we're always considering, is it the convertible market? Is it the fixed income market? Is it the equity market we want to go to? And that's going to change from time to time. I expect that mix will shift more heavily toward fixed income markets in Q1 as we go forward, because right now we're probably getting a little bit too delevered, and we'd like to actually get more leverage. We have about $7.2 billion of converts, but $4 billion of them are already essentially equity. They're through the strike price, they're through the call price, and they're trading with a delta approximately 100%. So they're looking like equity. And so we would like to go back and build more intelligent leverage for the benefit of our common stock shareholders.
Yeah, speaking of common stock, of course, one of the big pieces of news, as Katie has talked about, was your index inclusion in the NASDAQ 100. And one big question is, would you or are you selling newly issued stock to index trackers? Is equity something that you'd be looking to add to instead?
When we execute the ATM, we just sell equity into the market if we like the price and we like the terms. And if we think that the equity is undervalued, we don't. But we don't specify any particular buyer. I think that's just pari passu to every other investor in the market.
So I want to get a little bit philosophical because, we're talking now about NASDAQ 100 inclusion, and you're joining, of course, because MicroStrategy is nominally a software company. You founded it in 1989 as a software company. Do you still consider MicroStrategy a software company?
Well, we have a very healthy software division now, and we're very proud of it, and I did create it. But we think of ourselves primarily as a Bitcoin treasury company now. So our primary method of generating shareholder value is through our treasury operations. And if you think about, there's 3 ways to create value for the shareholders. There's operating income, and our software business generates about $75 million a year of operating income. There's also investment income. That's been difficult to track, but right now we have $18.6 billion of unrealized investment income. People will start to get a better handle on that when we switch to fair value accounting next year, and then you'll actually see investment income captured in GAAP accounting. And then the third way to create shareholder value is acquisition income. So when Apple buys back its own stock, or when Oracle does M&A acquisitions, or when you do an LBO, you're basically taking capital, which is cheap, to buy a capital asset, which is a higher return. So MicroStrategy is engaged in that capital acquisition process. We issue equity and debt. We buy Bitcoin. That's resulted in about a $14.4 billion benefit if you value the Bitcoin at 105 for our shareholders this year. And so we do all 3 of those. Obviously, the big numbers, the investment income, the acquisition income are more due to Bitcoin treasury operations.
Well, I'm glad you brought up the accounting rules in particular for this reason, because obviously NASDAQ 100, wondering now, with the rules around profitability for the S&P 500 inclusion, does that accounting rule get you to the place where you think that the S&P 500 comes next for you? And how soon do you think you can get there?
Obviously, it's the decision to enter the S&P 500 is above my pay grade. So they will make that decision. But I'm optimistic in 2025 when we adopt fair value accounting, when we end up with $50 billion of assets on our balance sheet under fair value. If Bitcoin goes up 20% a year, you're looking at $10 billion a year of investment income. So I expect we'll be generating billions of dollars a year or tens of billions of dollars a year of investment income, which becomes GAAP profitability. And I think that is the final thing people are looking for inclusion in the S&P.
And that would certainly be a sign of the times if you did get included in the S&P 500. So we'll have to keep in touch on that one. But I want to go back to the Bitcoin buying, and I want to talk about how you actually purchase the Bitcoin. Are you buying through an exchange, over the counter, peer-to-peer? This, of course, is made more interesting by the fact that obviously you're buying in bulk.
We use regulated exchanges in the United States like Coinbase. And when we're buying, we'll be buying on a simple like TWAP algorithm. So our goal is to not be noticed by the market, not to move the market. If anything happens with the Bitcoin price or even with the MicroStrategy price, it isn't us. Our objective is to basically be market participants, but never move it up or down or be noticed.
You know, it's interesting. I want to go back to something Katie was talking about before in definitions here. Are you a software company or not? But when you think about the legacy software business at MicroStrategy, what role does it have? Would you consider spinning it off?
No, we're very partial to it. We love the software business. I invented a large piece of it. We love our customers. We enjoy it. It's profitable, and it's a core part of the company's identity.
All right. Well, worth asking anyway. I am curious about, this unique treasury model that you have. Obviously, you've had great success at MicroStrategy with having a Bitcoin treasury. You recently pitched Microsoft, though, on investing in Bitcoin. That was rejected. But are you surprised that you haven't seen more traditional companies follow your lead here and invest in Bitcoin?
I think Microsoft's one of the great companies in the world, so they don't really have a need to adopt a new idea. But in essence, Microsoft's strategies are to buy their own stock back and to park short-term cash in treasuries and then to pay out dividends. That's very conventional. That's the finance playbook that would be taught at Harvard Business School. And if you're a successful company with a great business, you tend to stick with that playbook. The playbook changed, it changed a few days ago when fair value accounting became mandatory. When we go into 2025, I think you'll see the repeal of SAB 121. I think you'll see fair value accounting. I think you'll see Bitcoin embraced as a digital commodity by the regulators. We already can see the political winds are very favorably shifted. Now, for the first time in 100 years, large public companies have a capital asset that they can consider in lieu of treasury bills, and that's Bitcoin. It doesn't make sense to consider real estate or gold or paintings or barrels of oil as a treasury asset. It does make sense to consider Bitcoin. So really, we're year one of a new era, and I would think that the companies that embrace it first are the ones that have a need to know, or they're very close to the Bitcoin industry, the digital assets industry. The Magnificent Seven, they'll embrace it later because they don't need it now.
All right, Michael, that's a good place to leave it. Always great to speak with you. That, of course, is Michael Saylor. He is MicroStrategy chairman and co-founder. And don't miss the Bloomberg Crypto Show with Sonali and Tim Stenovic every Tuesday at noon Eastern. You already had your final show for the year, though, right?
Yes, we did. We're going to come back with vengeance in 2025, so I hear, as there will be new regulations, so they say. Big time, and a lot of crypto-friendly people in the Trump administration. And I don't know, maybe Michael Saylor will find his way there as well. But coming up, the biggest geopolitical challenges facing the incoming Trump administration. We'll discuss it in today's Wall Street Week with veteran diplomat Richard Haass. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And President-elect Donald Trump will face a number of geopolitical issues when he takes office next month. David Weston spoke with Richard Haass. He is a veteran diplomat and senior counselor at Centerview Partners about the global challenges the incoming administration will have to deal with.
Well, I think what he's left or what's in the inbox are a lot of good relations with America's allies, who are our partners around the world. You've obviously got conflict in Europe that is unresolved. You've got a very difficult relationship with China, this country's principal I don't know if you want to call it adversary or competitor in the world. You've got a Middle East that's gone through an extraordinarily difficult, 15 months, though we can talk about it. In some ways, there's signs of a significant strategic improvement. You got a world that's getting warmer. You've got a world where trade relations are having difficulty because there's no longer global trade talks. The mechanisms for dealing with trade are, shall we say, impaired. And you've also got not just strong countries, in some cases which have aligned, China, Russia, North Korea, and Iran, but you've also got any number of weak countries in the world, David, that can't meet many of the responsibilities of being a functioning state.
A fair number of challenges in there. Let's talk about possible opportunities. Start with the Middle East that you referred to. Is there a possible opportunity for the new President Trump actually to come in and bring some peace to that region that we haven't seen?
Absolutely, and I got to tell you, David, I don't often pair the words opportunity and Middle East, so this is something of a first for me. But yeah, I could see several opportunities. Probably the most significant might be between the United States and Iran. Iran is on its heels. It's lost much of the help it got from Hezbollah. No longer poses a serious threat to Israel. Iran also has to deal with the change of regime in Syria. Hamas has militarily been grounded down. And also Israel's demonstrated its ability to attack Iran with near impunity. So I think there's a real opportunity for the United States to approach Iran and say, hey, we want to get you out of the nuclear weapons business once and for all. We want to stop your program, make it verifiable what you have and don't have. And second of all, we want to end your support for proxies, for Hezbollah, for Hamas, for the Houthis who have interfered with shipping. And if they'll do that, we can then say, then we can talk about, for example, relaxing sanctions. But I think that's a major opportunity. I think at some point also there's an opportunity to get a ceasefire in Gaza, to get many, if hopefully all of the remaining hostages back. And then it's really up to the administration, the new administration, to what extent they then want to build on any of that and try to advance the Israeli-Palestinian process. But again, I think there's an opportunity there if they seize it.
The Middle East, largely, as far as I can tell, responds to power. Who's getting power, who's losing power? As we look at it right now, who's getting power? You mentioned Israel seems to be better off. Turkey also seems to be coming out of the Syria situation stronger.
Absolutely. I think Israel and Turkey, along with Saudi Arabia, are probably the constellation of local powers whose stock, if you will, has risen. Iran is the big strategic loser. Russia has its hands full in Ukraine, so Russia's ability to influence events in the region is much diminished.
And that was Richard Haas speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
The Fed's latest rate decision is expected in just about 3 hours, but who's counting? Investors are expecting a 25 basis point cut, but focuses will remain on the messaging for January's meeting. Joining us now, of course, Bloomberg Intelligence Chief U.S. Rate Strategist Ira Jersey. You know, we've been talking a lot on this program about how it's the path ahead that everyone's looking at this juncture. A lot of people still expecting a lot of volatility no matter what. I mean, how do you start to think through how things could move in any direction? I know that you tend to map these things out.
Yeah, I think firstly, we are perfectly priced for the Fed to not only cut today, but then more or less the pause in January, right? So any messaging that's not, I don't want to say explicit, right? Jay Powell's never going to be totally explicit, but that doesn't edge toward the fact that they might pause in their cutting cycle in January is likely to move the market, right? So if they come out and they say, you know, we're not sure yet, we don't know, we're still data dependent, blah blah blah, you know, then I suspect that actually we might actually see more of a cut priced for January. But there's a lot of other things. Remember, we have the SEP today, we have the dot plot. Plus, they might tweak the reverse repo facility rate, which is not getting a whole lot of attention in the general media, but could actually be really important to like money market nerds like myself.
Where is the most potential for a surprise here, especially when it comes to the dot plot? For a dovish surprise or a hawkish surprise, what do you think would cause the bigger stir? Well,
I think at this point, a dovish surprise. You know, we've priced out a whole lot of rate cuts for next year. So if he sounds a bit dovish, I think that the market might take that as a policy mistake mistake in the making, right? Where you can wind up seeing long end Treasury yields move higher, short end Treasury yields move a bit lower, more cuts priced in the market. But then a lot of people are going to say, the economy is in decent shape. Why are we cutting this aggressively when we're doing that? Now, I question whether or not rate cuts are actually having any impact on the economy at all. There's a variety of reasons for that, but nonetheless, that is certainly what the market narrative is going to be. So you can wind up seeing a pretty decent steepening of the yield curve.
Well, can you build on that? Because that has been a question, is whether or not this economy is less sensitive to rates and, of course, Fed policy than it has been in the past. I would just love to hear your thoughts on that.
Yeah, so look, let's go back 25 years, right? So basically, I started my career in the mid-1990s. You go back to the 2000 recession, basically corporate balance sheets became much cleaner. They termed out their debt. There's no more commercial paper that exists for corporate America. The same thing happened to the financial sector during the global financial crisis, 2007 to 2009. And COVID really cleaned up the household balance sheet, where households now don't have as much debt outside of maybe the mortgages that they're never ever going to replace unless they absolutely have to. So I'm not sure that there's a lot of sensitivity, and that the economy is very sensitive to interest rate moves that are, 2, 3, 4%. Now, if they raised it 10% or something, then clearly there would be something else, right? But I'm not sure that the economy is as sensitive to interest rates as it has been prior to even the 2007 recession.
Yeah, I mean, we can harp on that for a while, but I do want to go back, if you'll forgive me for being nerdy for a minute here, Katie. It's the repo market issue. Explain the ramifications there, because there were a lot of worries about kind of year-end funding stresses in the repo market, and I know it's the last day that matters, as you keep saying.
December 18th.
But there are 13 days left of the year. Yeah. And so what worry is there really still about the plumbing under the hood?
Sure. So we're getting pretty close to bank reserves being at the level that is probably consistent with this lowest comfortable level of reserve idea that the Federal Reserve is looking very closely at. So when you saw quarter end and what happened to the repo market at quarter end, you saw a spike in repo rates. So that meant that there was a lack of funding that was available. It's going to be just as bad, if not worse, at year end this year. We're already pricing for that. So when you look at where forward repo rates are pricing right now for the year end turn, we're already pricing for interest rates maybe to be 60 basis points above where the Fed funds rate is going to be, after today's rate cut, because that's fully priced. So that means that the Fed at some point has to stop quantitative tightening, and it's going to it wants to tweak the this RRP facility rate to try and drain that and kind of add a little bit of reserves into the system. It's probably not going to work, I think. In fact, we put that in a note we put out Monday. But nonetheless, I think that they're going to attempt that by cutting that repo rate just 5 basis points. But that means a lot of different interest rates might go down 30 basis points instead of only 25.
We have a minute left with you. Your name is Ira Jersey, but if your name was Mike McKee, if you were in Washington in the press conference, what would you ask Jerome Powell today?
Yeah, so I actually sent this suggestion to Mike yesterday. So I would ask about that reverse repo rate, because all the basic questions are going to be answered, right, about the SEP, why the dots moved and all that. But let's get into the plumbing a little bit. What are the frictions that they see in terms of how they're managing their balance sheet right now? And what do they anticipate them having to do, even though they're going to stop, maybe slow cutting? Will they stop quantitative tightening, and then will they ultimately have to start increasing its balance sheet at some point in the near future?
All right, Ira Jersey, great to get a preview with you on set, which is a rare delight. That is Ira Jersey of Bloomberg Intelligence. And stay with Bloomberg for our special coverage. The Fed Decides starts at 1:30 p.m. today, and we'll see. I mean, again, we all know what's going to happen at 2 p.m., but what he says about next year at 2:30 p.m., things could get a little bit interesting.
I'm really excited to see about this RRP facility, too. I mean, it's just insane to me that you're sitting at a Fed with about almost $7 trillion on its balance sheet still. Yeah. We're talking about the lack of tightening. Anyways, don't go anywhere. Of course, the Fed Decides later up, and tune in tomorrow. This was Open Interest. This is Bloomberg.